Welcome to Real Estate and Murder, a podcast about real estate and murder.
I am Amy Brockbank.
And I am Sarah Brager. We are both licensed real estate agents in the state of Utah who have a common fascination with true crime.
We are here to tell you stories of murder amongst the real estate community. It might be an agent, it might be a client, it might be an undetected serial killer.
When it comes to real estate crimes, some are predators and some are prey.
We just want to issue a trigger warning. The content of these cases can be difficult to hear from time to time, and please listen with care.
Hi, everybody.
Hey.
Hey, welcome back to Real Estate and Murder.
Yes.
This is the bonus content, right?
It is the bonus content. We're so excited.
Hi, Amy.
Hey, Sarah.
And hi, David.
Well, hello.
David is our special guest today, which we're really excited about. We love having guests, don't we?
Yes, David is with Bonk Lending, so he helps us with the mortgage end of it with our clients.
Which is the complexity of the real estate transaction, in my opinion. Like, the most complex part is the lending factor, and I think the most intimidating part for a lot of potential buyers. And so I'm glad we get to talk about this.
Yeah, I think it's the part of the transaction that they feel really exposed.
Sure. Yeah.
Because someone's digging through their financial history.
Yeah, absolutely. Which can hold people back sometimes, I'm sure, Dave. I mean, let's just start off there then, because one of my questions for you was I've had the pleasure of dealing with a lot of first-time home buyers. They're actually my favorite kind of category of buyers. I love them. I love the challenge of it. I love walking through someone with the whole transaction and making sure they're comfortable. But I do oftentimes get a phone call or just casually, mentioned at a showing or something like, hey, the lender's requesting all this stuff, and do I really have to give it to them? I'm assuming you get that sometimes too.
Absolutely.
So let's just kind of talk about the disclosure of that. I recently got a loan as well myself, and yeah, there's some vulnerability there, and there's some sensitive information potentially. And so how do you go about that with your clients? We'll say sometimes we share the same client when we're lucky to, but how do you go about it with your clients?
Well, specifically talking about first-time home buyers, I feel like one of the biggest gaps in the things in our industry that we have is there's not enough education so that when we're asking for documents, they know why we're asking for these documents. Because we don't like to ask for half of them. The problem is Fannie, Freddie, and HUD require us to. And so we have to ask for them.
You brought up some words that maybe our listeners aren't familiar with. What is Fannie, Freddie, and HUD?
Okay, so Fannie and Freddie are who basically regulate conventional loans, and HUD is FHA. So HUD regulates FHA loans. So we have to adhere and write loans to their guidelines, the guidelines they say. And as long as we do that, it becomes an insurable loan.
So everybody that takes out a loan in the United States has the same set of guidelines that they have to follow.
Yes.
Perfect.
Basic guidelines,
yeah.
Right? And then there's scenario to scenario.
Yeah, there's
right?
different types of loans you can get because you mentioned conventional and FHA were two different kinds of loans, but there are certain guidelines that each loan has to follow.
Yeah.
Yes, each one's going to be specific because we write conventional FHA, USDA, VA is one of our favorite ones to write, and all of those guidelines are going to be a little bit different. Some are going to be easier loans to get, some are going to be harder loans to get, right? But going back to what we said, though, I think the basics of it is if people aren't educated, especially being first-time home buyers, on what the process is and why we're asking for it and what those things we are asking for are, then it's going to feel like a really chaotic process.
Yeah, it can be, especially when they go under contract because they love this home, and now they have anywhere from 20 to 30 days typically, right, to get all of their financing approved and finalized. And so there are moments where they have to request or they're getting documents last minute, and it's like do or die. You have to have this to me by 5:00 today. Or the potential is you could lose the house. You could lose the deal, right? So that is emotionally straining.
Yes.
Right? It's stressful, and understandably so. I just find that a lot of buyers are kind of like, okay, we'll just do it. We'll figure it out later. We'll just do it. And that can be intimidating. Like, I sympathize with a buyer who feels stressed or strained about getting documents over. So I think that education, you're right. I think that's missing. So going along with that, then what do you do to educate let's just call it any buyer, because first-time home buyers could be, well, the last time I bought a home was 10 years ago. So doing it again, just recently, I felt like a first-time home buyer, and I do this every day. So how do you talk to clients through that education process?
Yes, and technically you are a first-time home buyer.
Exactly,
because
that's what I'm
you're 3 years
saying.
off title.
Yeah.
But yes, so the way I always do it, I like to have a conversation with clients, get them on the phone, have a 10-minute conversation, because it's not the client's job to try and figure out what loan is best for them or what scenario to put them in. It's my job as the loan officer, so that I don't have to fill them with a whole bunch of crap in their head about all these different loans, when I can just pick their brain for 5 minutes and I can 90% of the time tell what loan they're going to fit into. And then we can talk the specifics of that loan and the requirements.
Mm-hmm. Okay. So just kind of in an initial conversation, you feel it out, and then help direct them from there.
Yep. And then once we get that initial conversation done, then we can take application, pull credit, and be able to see the things that, hurdles we'll have to jump through, or the things that we're going to be able to get through quick.
Yeah.
So, David, how long have you been doing loans?
About 5 years now.
So you've seen a lot of different scenarios in your 5 years.
I have.
Is for the homeowner or the buyer that is trying to go out and wanting to apply and feeling like, they made some bad choices in college, or, they, all of this stuff that we get caught up in when we're younger.
Student debt.
Yeah.
I see that all the time.
What, I know you're not judging them, but how do you, what am I trying to
How do you
say
make
here?
a buyer feel comfortable
Yeah.
or safe in that conversation? Like, hey, your credit score is a 300. You have $15,000 in credit debt. You have a student loan for something you're not doing for your profession nowadays. Hey, this one's going to be tough. How do you, make them feel comfortable?
Well, first off, it's not my job to try and how do I say this? Like, criticize or make them feel bad about anything. My job is to go in there as someone on their team to help them. So if I get someone with a lower credit score, I'm by far not a credit repair person, right? Like, there's professionals for that. But we do know some little tricks to the trade, and it's my job to help them and explain and get them to where we can get their credit score up. Because just because they come and I can't qualify, or they've got bad debt, or they've got something crazy going on, potentially in a couple of months, we could have them ready.
Yeah.
And so I don't want them walking away thinking I'll never be able to buy. I want them walking away with a game plan of, this is how I'm going to buy a house.
Yeah.
I think it's important for people to know that it's never a no. It's just maybe a not right now.
Or here's how you do it to get there.
Yeah.
Yes.
Right? Like a game plan. And in the last 5 years, because I've been in real estate about the same time as you, we've seen so much shift and change, not only in the market, but in lending, right? Like, things are dramatically different than in 2019 and 2018 when I was getting licensed and learning the ropes. So lending has, I don't want to use the word like loosened up, but shifted a lot. There's different ways to get approved and to do different types of approvals that just didn't exist before, right? Or maybe didn't exist to the accessibility that they are now. So why don't you tell us some unique scenarios? You have a buyer that comes and knocks on your doors like, I'd like to get a loan, but I don't know where to start. Maybe they're self-employed. Maybe they do still carry, $100,000 of student debt. Or, what are some common hurdles that you see and sort of the approaches to fixing them?
So honestly, like, in today's, I'd say, scenario with like how the younger generation is right now, a lot of the scenarios we see is debt on credit, right? It's like, it seems like a lot of people are creating more and more debt, but I'm specifically talking about like auto loans. A lot of first-time homebuyers come in, they're making $60,000, $70,000 a year, but they have a $600 to $1,000 truck payment.
Isn't that crazy?
Or car payment.
Cars are so expensive now.
Are.
Yes.
I know, like, starting into a brand new car is like $40,000 or $50,000
For your basic model.
Yeah.
Welcome to Real Estate and Murder, the car edition. But they are so expensive. So I get it. Keep going.
Yeah, so if you think about the way we qualify is using your gross monthly income, and then depending on the program, we can use a percentage of that to qualify for your monthly bills on credit and your proposed housing payment, right? And so if someone's making $6,000 a year because they make $6,000 a month because they make $72,000 a year, I can only qualify like $3,000 in payment.
Mm-hmm.
But then they got $1,000 truck payment.
Yeah.
Now that goes to $2,000, we can qualify for a housing payment.
Right.
So that's honestly one of our biggest hurdles right now is just getting people to qualify because of the debt on credit.
Mm-hmm. Okay, so let's talk. Amy and I actually kind of briefly touched on this subject in one of the recent bonus content episodes that we did about the strategy. We don't have to get into detail, but for the generation that is home buyers and first-time home buyers right now, right?
Mm-hmm.
Like you're saying, there's a lot of credit card debt. Credit card debt is at an all-time high, we know, and rates for credit card debt are at an all-time high.
Yes.
I was telling Amy, I think that was a surprise Amy moment where I told her like the average credit card, and I have a new address, so I'm getting 100 credit card offers a day in the mail, right? Are like 36 to 39% APR. Okay, insane. So isn't there the potential or the possibility to take some of that debt, roll it in, get it paid off, figure out how to sort of consolidate, if you will, maybe that's not the word you use, but sort of change the structure of their debt in order to be able to afford a home. But now you have mortgage debt that's actually good for you,
mm-hmm.
as opposed to credit card debt, which actually hurts you.
Yes.
Right?
And that's one of the things we do when qualifying a client. If they come in with a bunch of credit card debt, because your payment's going to be really high and the amount you owe is going to be lower. So you figure someone that has $5,000 in debt could have a $200-$300 payment that goes along with that, in just credit card. So we can take down payment and shift things around. Instead of having them pay this much in down payment, we'll take some of this, we'll pay off some of the debt. That'll free up their debt to income and be able to help them qualify for more, because you can get more bang for your buck paying off some of those debts than putting it as a down payment on the house.
Right. Yeah, that's very true. And that just brings me to kind of a scenario I see commonly enough that sort of goes along with this. Oftentimes you see two people on a loan application, sometimes more, traditionally like a couple that's moving in together, whatever that dynamic is, right? But maybe one works and one doesn't, or one has a really good credit history and the other one doesn't. I have seen scenarios work out where it's only beneficial to have one person on the application actually, right? Like let's remove the partner that isn't bringing in income or has more debt or whatever. But hey, what if we refinance that card payment you have just into your partner's name that's not on the application? You just freed up $600 to $800 of, like you were saying, of debt to income every month, and now we've got clearance on that.
Yes. And that is something we do all the time.
Yeah.
It is a touchy subject because
sure, of course.
Whenever we ask a spouse to not be on the loan, it's almost like we have to tiptoe around that because they can get really defensive of, well, I want my stake in the house. And
Sure.
if I'm not in the loan, then it's not my house, right? When that's not actually true,
right?
So who controls the note is not the note of the loan is not necessarily the only sole per person on the property. It's going to be the title, and we can always 99%. There is a program that doesn't allow us to, but on almost every program, we can add the spouse to the title at closing, and they still have their vested interest.
Yeah, exactly.
Well, and we should mention that this is for Utah. There may be other states where this
Sure.
is a little different.
Yes.
So check with your...
And lending scenarios are always case by case, no matter what.
Yeah.
But these are interesting things that I think your average consumer would have no idea that these are, like I said, hurdles that you can overcome.
Or options.
With simple fixes.
Yeah.
Yeah.
I wanted to ask, what if someone comes in, they, have done everything right except for the fact that they don't have a down payment? Are there ways that they can get around a house with no down payment?
Yes. So there's a couple loan programs just right off the bat, depending on the area you're willing to move to. USDA is a zero down program. You actually get a better rate, better mortgage insurance, better upfront insurance, if you're willing to move outside and into the rural areas. And then there's also VA, but vets usually know right off the bat. That's usually the first thing they tell us is we're VA.
So just for that, again, average consumer listening to this, tell us what USDA stands for, what VA stands for, and I know what you're going to get into next. So give us the long form so that everyone can understand exactly what we're talking about.
Okay, so when you think of USDA, you think of going to the grocery store, seeing a slab of beef or a steak that's
where my mind went.
USDA, right?
Yeah.
It is the same government agency. What it is, so it's the United States Department of Agriculture. They created a loan to try and stimulate the rural areas, to try and incentivize people to go to the rural areas. So you can go to USDA.com and look up on the loans. There's a map that'll show you where is eligible and not. So this one, so like if we're talking Utah County specific, like south of Santaquin, kind of like Santaquin and
Yep.
south, kind of a rough little area is all considered USDA.
Rough
You
like
know.
rural,
Yeah.
not rough like the streets of Payson.
Yeah.
Rough like rural.
Yeah, you might find some farm animals there. Like,
Yeah.
I mean, that's the
Yeah.
goal, is that it is.
There's a really mean cow.
Yeah, and every,
Betty.
periodically they change the guidelines depending on, the census and how many people live there and how much actual rural stuff is happening there. Then they could say it is or isn't. There was some areas this last year they took off and made not USDA eligible anymore.
Yep.
How
So-
often do they reevaluate the areas?
I honestly I don't
Every
know.
few
I want to
years,
say it was
right?
every 4 years
Yeah.
they
I was
redo
going to
it.
guess 3 to 5. So.
Yeah, I think it's every 4 years
3
if
to
I
5.
remember correctly. But I know it's
5, 1 to 10.
yeah.
Yeah. when
It
enough
was-
census data has changed.
Yeah.
There's no
Yeah.
point in doing it year to year because probably not enough changes happened.
Yeah, and it was last year. Last year is
Last
when
year
they
it was.
redid the guideline, redid the boundaries.
Yep.
Yep.
Okay, so USDA.
So USDA. Now VA, I mean, that's
Which
your
is?
veterans.
Yeah.
Right? So that's anyone that has served a certain period of time in the military, or been to war and had enough time eligible there. They're going to get, and every vet knows, they're very, at least my experience with the vets is they're very connected to their benefits. And they know if they have benefits or not. And so what we have to do is we have to get their DD-214, and then we go to the VA and request their documents, right? So that's where we're going to get their COE, which is their certificate of eligibility, and that tells us if they have benefits or not.
Okay.
And that specifically alone is what I say, like, I feel like our government hasn't done our vets justice, but they did them really good in the mortgage world.
They did.
Because it is by far the best loan you can get.
Yep, it absolutely is. I have the pleasure of being able to use that. Thank you to my husband. But
Yes.
we're very fortunate because of that, because we were able to go no down payment, even though we could have put one down if we wanted, because of, Utah County specifically where we live. My husband, because of a part of the type of benefit and eligibility he has because of his service, we're property tax exempt.
Yep.
And the VA loan doesn't have PMI, which is private mortgage insurance, which would have been anywhere from probably $300 to $400 on the amount of our loan, right? So I agree with you. There is one area where the government does serve our veterans, fairly, I think, in that department. And that's going to be different in your area and with your service. But I'm just saying, I can specifically relate to that.
Yeah, and if there's any vets listening right now and you do have a VA loan, if you haven't been told, just what Sarah was just saying, if you have any kind of disability that's associated with your military benefits, you can go to the county and request to have some of your taxes either offset or completely gone.
Yep.
So definitely go to the county and just check and see, because you could save yourself a little bit of money every month.
Absolutely. So that's a great loan. Okay, what else are we? You did USDA, VA.
Yes, and then our big one in Utah is Utah Housing.
Right.
Utah Housing is an FHA loan, and so basically what they do is we write a traditional FHA loan, except for that Utah Housing supplies a 6%, when I say 6%, it's 6% of your purchase price, loan to cover your 3.5% down payment and some of your closing costs. Now, the downfall is you end up with a higher fixed rate, from Utah Housing, where if you went traditionally FHA, you wouldn't. But you wouldn't have as high as a rate. But it gives you a lot more, if you don't have a down payment, resources to go get into a house.
Right. Which I think objectively, if you step back and look at lending, I think that there's some fairness to that, right? Like it provides buyers who don't have down payment or closing costs still the ability to go purchase a home, but it carries a slightly higher interest rate to pay back that huge benefit that they're able to get. So, I mean, that makes sense to me.
I think as buyers, that's the biggest hurdle that they have when they're looking at 3.5% of a purchase price. We need $17,000 or $20,000 to put down, and a lot of people just don't have that. So it's great to have the options where that's not necessarily what you have to get into a house.
Yeah.
Yeah.
I mean, I think that's true. I believe that every American should have the ability, the right, the chance to purchase a home and have home ownership if that's what they want. But in a sense, it does have to be earned, right? There has to be responsibility and financial accountability and all those things in order to be given a loan for $500,000 or more, you know. So I think that's a great way to give buyers the potential and the opportunity. And there is just that little bit of extra in exchange, though.
Yes. And the easiest way to think about this when it comes to lending is everything we do is based off of risk. You know, because the
Right.
investor, like you're just saying, is going to give us on that loan specifically $500,000, a little over $500,000 for a $500,000 house.
Mm-hmm.
So if you were to buy that house on this loan and then 6 months later you said screw it and you destroyed the house, decided not to make the payments, the investor actually just lost money on that loan. So come along with it, you're going to get a higher rate with the bigger the risk. So we look at risk as lower credit's considered high risk. High credit's low risk, you know, and then down payment is your LTV, which is your loan to value.
Mm-hmm.
If the loan to value is at 100%, it's a super high risk for the investor. If you come in with 10%, 20% down, it's now very low risk. So your rate gets better. The terms get better. Everything gets better about the loan. The higher the credit, the more money you have.
Sure. Makes sense.
And David just mentioned the word investor, and it's not the typical, like, oh, I'm going to buy this property and rent it out. An investor in David's is like the bank acts like the investor who is loaning the money. So just for our audience.
Good point. Great point. So do you want to talk a little bit about what makes a rate? Not what rates are, because we get that question every day, and it's always a variable, right? I'm sure you get that question every day. I know that as agents, Amy and I get that question, well, what's today's rate? First of all, I'm not touching that with a 10-foot pole, but I can tell you the range, you know, and I can direct you to a professional that can work with you about your rate. But what is the recipe for a rate?
So, I mean, that would be super complicated. One, I'd probably confuse everybody if I talked about it. But what I want to talk about is when it comes to rates, a lot of people hear the Fed rate and think that that is the rate that we're going off of, right? It is not. The Fed rate has nothing to do with us, right? But it does indirectly affect us, right? And so what goes into our rates is we're looking at, one, if the economy, and this is bad to say, but if the economy in the world is doing really crappy, you're going to see rates get better to try and stimulate the economy, to try and stimulate the world.
Yeah.
When the world's doing really well, you're going to see rates go up. So if you think about, you go back to 2020, 2021, when we were seeing the lowest rates we've ever seen, you know, it was COVID. COVID directly affected that. So what happened is drove the rates down, started buying up the mortgage bonds, you know, mortgage-backed securities, but these governments started buying them up, which caused rates to just drop drastically, which meant, like, as a consumer, there's more money in my pocket. I can go buy more stuff. I can go do more stuff, which helps me stimulate the economy.
Right.
Now you look at 2022, 2023, you know, and into today, job report numbers are coming out, and they've been saying until just recently that, you know, unemployment's at an all-time low, so the economy's doing good, right? New jobs being created are, you know, all-time high, so the economy's doing good. So that's why rates drive up to try and stop that, right? It's kind of this weird battle of if everything's good out in the world, you know, you're not going to see interest rates real low. If things are bad, you'll start to see interest rates go low.
So, David, I have a question for you. So, the Fed has their rate, which affects like consumer credit, like credit card companies, anything that we lend with, auto loans, things like that. So, let's say we've talked a lot about first-time home buyers, but let's say we have a scenario where a person bought a house in 2020 and their rate is really, really low. They have, because the price of eggs is $9 to go to the grocery store, have had to use their credit card to fund some of their lifestyle
Day-to-day
purchases.
needs.
And now they're in a scenario where their mortgage payment is low because of the interest, but they have a lot of credit cards. What do you recommend for them?
Each scenario on this is going to be different for each person.
Of course.
Right? Because we have to look at a bunch of different things. One, your current mortgage payment being low, we could always do a cash out refi and we could pay off all that debt, get you in a better place. But you have to understand you're now putting that debt into a 30-year amortization schedule, which means you're going to pay more even with a lower interest rate than if you were just to buckle down and pay that credit card off. Now, if someone's in a really bad spot where they have to pay those off no matter what, then yes, we can talk. Because the last thing I want to do is take someone's 2.5% interest rate and say, hey, come get one that's significantly higher with me on a cash out refi, right? Because technically I'm not doing them a favor.
Yeah, but what if, they're in a townhouse and they need to upgrade because, they have enough 4 kids and they don't want to lose their rate, but there's scenarios where you can show them that actually moving would benefit them in the long run because of their credit card and all their other stuff as they,
Yes.
right?
So I had a situation like this just barely. So I had a client that lived in a rural area. They owed very little on their house. We put it up for sale. Not me, but the agent put the house up for sale to try and sell it because they needed to move to Utah County to be able to be here for a job. It was a teacher job, so it started a month ago, a month and a half ago. And so their house out in this rural area did not sell. Nobody even came and looked at it. But they were contingent on we had to pay out some debt and we had to have a down payment to qualify them. So talking to them, I was able to show them that, hey, if you keep this house, because that area doesn't have rentals, you now have the ability to rent that place out. You have a very low payment with it. You're actually going to net more money, each month by holding on to this. And so we were able to, on that one, it made sense to do a small cash out refi, into an investment property, hang on to that house because they were still going to cash flow money, and be able to have their house down here in Utah County. So
Interesting.
there is different scenarios where we can go into, maybe you don't sell the house and you keep it as an investment. A lot of people in the general public don't understand, what it takes when you hold on to property and invest instead of thinking I got to sell so I can cash out and put it on the next house or, vice versa. So people can go get into in the situation you're talking about, right? There is the ability, like if they have that low of an interest rate and their payment say is $1,200 on this place, but they can rent it for $2,000, maybe it's worth keeping going into the next house. They're now positive $800 a month that can offset that higher payment on the other house.
Sure. There's that's a fascinating solution to a complicated problem. Like, yeah. I love that. Yeah. And also, I think, Amy, what you're talking about, we have discussed previously, where getting rid of that credit card debt at 36% APR is worth exchanging your mortgage at 2.5% interest rate for a mortgage maybe even a little bit higher. You get a different home, a new home, a bigger home. Mm-hmm. Maybe you want to downsize. It doesn't really matter, but whatever the buyer's goal is, they can change their property, take a higher interest rate, sure, but use the profits or the proceeds from the sale of their initial property to pay off all of that debt that's actually significantly heavier and higher and more damaging long-term than a higher mortgage rate, right? So, but I think a lot of consumers, like you said, don't understand that initially. And even I had to work my brain through that when we started talking about that as a solution, in the last few years. But you're seeing that come up more regularly now, right?
Yes. And I guess, so getting deeper into that would be a scenario. I always try and preach, if you can hold your properties, hold them. Rent them, right? It's the best investment.
It's monopoly.
Retirement,
keep them.
You look at a lot of the really uber rich people in this country. They're into real estate.
Yeah.
That's where they found their riches. But not every situation is the same, right? And so, like you're saying, if someone does have that much debt, it might be worth selling and paying all that debt off so they can get ahead.
Yeah, sure.
That's where every situation is going to be different. And the other thing is if you look at someone who has that much debt, unless they make $150,000, $200,000 a year, it's going to be hard pressed to qualify them for a house that's $500,000 to $800,000.
Which is so difficult now, though. I just want to say, as we're using these terms and talking about this, there's no shame in debt necessarily, right? Yeah. A lot of people opt into debt for many different reasons. That doesn't mean that everyone also makes the best decisions when going into debt, but it's not all bad either. I would say, most Americans are, or at some point are in debt. So it's not, not shaming debt as a common factor that comes up in financials.
This is not the Dave Ramsey show.
Yeah. We're not going to shame anybody for that. But there are creative solutions and fixes sometimes to find a better way out of that. But debt is, hashtag normalize debt. It's okay because also, we have seen it. Amy and I have, our sons are the same age, and Amy's got two other children that are a little bit older that have been recently going through home buying scenarios, and we talk about our children being concerned about their ability to afford housing up and coming, and what are what's like the average, what is the term, you guys, like when you start into a new career and it's like the kind of the first benchmark for pay. What do I say, like entry level? What's like the entry level, pay for a 21-year-old coming out of college or a 22-year-old? How do you balance all of those things for the future for your kids? And so debt is going to come up. It's going to come up a lot, right? Because you're buying 500,000. And we're talking about Utah now.
Yes.
But this applies in many other parts of the country as well. Talking about buying $500,000 on average homes, let's just say that, at what salaries and with what debt? Like, it's cumbersome. Like, and it has to be strategized in a way that benefits the buyer individually. And you really do have to have good people on your team, like you said, Dave, on your team to be able to do that, which brings me to another question. What do you consider, as a lender, what do you consider to be a good agent, a real estate agent? When you're working a deal with a real estate agent, you're the lender, and you guys are working with a buyer. Doesn't matter if it's first time home or not. It doesn't matter. What do you consider to be an excellent performing agent?
Really someone that's just going to go out there with your best interest in mind. So I work with a lot of different agents, and there's some agents that when I say, hey, let's try and get, 6% concessions, they get really like soft almost, and well, we can't ask, and then they'll go out and ask for 1.5%, right? And they'll get the 1.5%, but they didn't even ask for more, right? And I feel like having that person that's gonna have your back and be real assertive with the negotiations and being able to go out there and actually battle for you. You know what I mean? Like, we had the one, Amy, where honestly, when you told me we're putting $100,000 less on our offer, I was like, you're smoking something funny. Like, that's not going to happen. And what happened? You battled it and got them the contract for $100,000 less.
My client basically got a price of a house for the land. I mean,
yes.
Yeah,
And
essentially.
so that's the difference is, like, I personally know other agents that if they would have been in that scenario, they would have said, oh, they won't accept that. Let's not do this, and not go to battle for them.
Yeah.
So it sounds like an agent that actually like strategizes with you and then goes and represents that need of the buyer, in order to qualify for the financing, in order to make this really work for our buyer. Agent, this is what I need from you. And it sounds like what you're saying is an agent that understands the reason why, and finds a way to make that work. And just to be fair, though, it might not work with every seller. You might have to go to a different seller.
Yeah.
Yes.
But there is a scenario in which it will work, right?
Well, and honestly, we're all on the same team. Whether you're the listing agent, a buying agent, the lender, title, like everybody's trying to get the same end result. And I think there's a lot to be said about the agents that will stand up for their clients and get their best interest, but also work together as a team and not disparage anybody or, as in the process of.
Well, and Amy, I think that the best agents are the ones that see that and understand that. Like, I don't consider myself, when I'm a listing agent, to be in opposition to the buyer's agent, and vice versa. When I'm the buyer's agent, I want the listing agent to know and understand that we have a common goal to achieve here, and we are on a team. So I think the most professional real estate agents in our field are the ones that have that common goal as the priority.
I mean, we all represent our own client, but also too, you can do it in a way where we're all still on the same team.
Yeah, exactly. I mean, you don't have to necessarily brand yourself or carry yourself as, oh, I'm a bulldog agent, or I'm a this agent, or I'm skilled at this. Well, let's just be skilled at getting transactions done,
Yeah.
Yeah. And I would honestly say you can tell, especially back in like 2021 and, when, people were paying way above asking price and, like everything was just kind of going crazy in the market and it wasn't good for buyers. You could tell the difference between a new agent that didn't have a lot of history with real estate and someone that's been doing it for a minute, because they were able to write contracts in a way that offers would still get accepted. So I'd really say like one of the best things is getting someone that knows what they're doing, and if they are newer, make sure they have a team behind them that's going to help them write the contract and help them do stuff.
Sure. Yeah. That's fair.
So David, before we end, we want to know what your most crazy or one of your craziest loans without giving, obviously, confidential information?
Yes. Okay. So this one, there's a couple, but this one I'm talking about, so it was actually me and Sarah's deal. Um, but so a few years ago in June, we had a client under contract.
Oh my gosh. Okay,
Yes.
yeah.
And so when you're going through the contract, there's deadlines you have to make, right? And when we talk about lending, we send out a CD, which is the closing disclosure. That's after you've been final approved, everything's good. Once you sign that, it starts a timer that you cannot close for 3 days, okay? And it excludes federal holidays. So Sarah had gone to battle on this, and we had gotten our client under contract, and this listing agent was not happy after she realized what it actually like the kind of deal that they were getting. Right? You remember that? How she was
But
yeah, and so we get the CD out on time.
Yep.
We're supposed to close on a Monday.
Yep.
And our president says, "Surprise! There's a federal holiday on Saturday," which now means we're out of compliance and cannot legally close on Monday, which means our settlement date is Monday and we're technically out of contract.
Yep.
Right? And so I called the listing agent. I can't remember if I called her or she called me, but she told me, we're going to keep your earnest money and you know, like we're not going to do this.
We're going to keep your option money or earnest money. We're taking, and it was $30,000.
Yep.
We're going to take all that money. We're going to keep it and go back to market because you're technically out of contract based on this brand new federal holiday.
Yep. And I held my tongue and tried not to be out of control, but called Sarah right after and was like, handle it.
And we did.
She did. She got it done for us. But it was a stressful day because we really thought that our client was losing $30,000.
Yeah. And it was an initial gut reaction, I think, that agent had. Like, I mean, I don't know what had gone wrong in her day or, you know, whatever had happened. She got the wrong coffee at Starbucks or whatever. But we were able to work through that just as a sense of reasonability. I mean, also, like that loan, I mean, that would have just been so terrible to do to someone. But the reality of it is we were technically out of compliance by no fault of our own or, you know, just coincidental timing. So just, you know, side note, when you decide to make a federal holiday, like give everyone a heads up a little bit so that we can all accommodate contractual deadlines. So that one was crazy because there was a lot at stake. A lot. But we did get through it. Good job. High five. All right. Well, are you going to come back and talk with us again on an episode about crime?
Absolutely.
Real estate crime. Because there are a couple ones that involve lenders. And I'm just saying, I would love to know if you're ever mad enough at a potential buyer to go out and kill them. I'm just saying that's a hint at an upcoming episode, you guys.
Speaking of upcoming episodes, Friday, September 13th, our season 2 drops. So next week, we're back to murder.
Friday the 13th.
Yep, not just real estate.
Yeah. Well, Dave, thanks for coming in and talking to us. I mean, I love the information that we get out of these just really, like, close but intimate conversations about what we do in our field, and I think it's very informational. So
yeah, thanks so much for coming in.
Well, thanks for having me. And just side note, anyone listening to this, these are 2 of my favorite agents that I work with. So
thank you.
You guys got some good people.
Thank you. 3 of us here make a good, team, sure, whatever, but we all respect each other professionally and really enjoy personal relationships too. So thank you for coming in and sharing that with us.
All right.
Awesome. Thanks, Dave. Bye, Amy.
Bye,
Thanks, guys.
Sarah.
Talk to you later.